I'm Selena Wang in San Francisco, and for Emily Chang, this is Bloomberg Technology. Coming up in the next hour, Apple misses. The company underwhelms with its forecast for holiday sales. Have its pricier new iPhones failed to spark consumer excitement? Plus, Google walkout. Employees of the search giant around the world protest against the company's handling of sexual misconduct in mass stop works around the world. We'll discuss Google's reaction to reports about its cover-up of multiple claims against executives. And off-tune, Spotify reveals plans to boost spending to drive growth. But Wall Street's dancing to a different beat. Shares slump over concerns surrounding the company's revenue forecasts. But first to our top story. Apple shares are falling in late trading after reporting an underwhelming forecast for the key holiday period. The earnings suggest a weaker than expected demand for the company's pricier new iPhones. In terms of the fourth quarter, sales rose 20% to $62.9 billion, and profit came in at $2.91 a share. The analyst call is about to begin, and we will bring you the latest throughout the hour. And likely to be on the call is Tim Cook on his birthday, and CFO Luca Maestri. Joining us now in Boston, Horace DeJew, a Simco analyst, and with us in San Francisco, Julie Ask-Forrester. Horace, I want to start out with you. Seems to be a bit of a mixed bag. We had the current quarter beat on the top and bottom line, yet the forecast was underwhelming. What's your take on this?
Yeah, exactly right. I think we had a great third quarter, in terms of third calendar, fourth fiscal, but we're a little bit disappointed on the guidance here a little bit. It looks to be perhaps indicating emerging market or China slowdowns, and frankly, it's flat. Considering the product mix they have, it's a flat forecast with zero growth in the iPhone.
And Julie, a big change of focus is less on the number of iPhones sold, but the average selling price, which has continued to increase and beat analyst expectations. But how much further can they juice this price from these same consumers?
So far, there really haven't seemed to be that many limits. I mean, if we look at Apple's opportunities in terms of revenue growth, they need to find more customers. And most of the growth in the smartphone market is coming out of markets like Indonesia, Nigeria, and India, where there are, let's say, the percentage of the population that can afford one of their devices is in the high. You can increase revenue, or you can sell more products. And certainly, while the wearables and the other devices are doing well, there is no other it product like a smartphone that consumers really feel they have to have.
And Horace, now these results only show about 2 weeks of the newest iPhone sales, the XR, the XR Max, etc. What do we know about how those have performed so far?
Well, again, the signals are pretty good as far as what we're seeing from sampling on the retail side. But the problem is we just don't know if there's going to be, again, some kind of structural issue in China. We also, as far as the pricing is concerned, yes, it's gone up, but there's still quite a bit of mix out there. The iPhone, the newest XR, has not yet really shown us a lot of data, and the XR is really the driver. Is going to be the driver for China and other emerging markets, I believe. And it's a little bit of a puzzle to me why we're not seeing the sort of enthusiasm from guidance.
Right, we're actually seeing most of the FANG stocks down right now. Apple was the last to report. The hope was that it might lift the tech sector. And what do you think now? We're seeing stocks down. Investors seem underwhelmed. Is this going to change perhaps later in the day?
Hard to say on the whole market. I'm sort of looking at Apple alone. We're seeing a little bit less enthusiasm, I think, from management. We just had 2 days ago new products, meat and potatoes products. These are just the middle of the market. The new Air is a little bit pricier, but it's certainly getting a nice boost in terms of functionality. And not to see that reflected in guidance is a little disappointing.
And now, actually, Tim Cook gave an interview earlier with Reuters, citing some macroeconomic weakness in some emerging markets. Now, in China, there's obviously concern that the trade tensions could be leading to a dampening consumer sentiment. Are we seeing that at all in the numbers? Is there concern about this?
Yeah, so stepping aside from the numbers just a little bit, I think, when you look at Apple and who their target audience is, which does tend to be more affluent, even in markets like China and India, which are some of the larger markets, I think, even over the past 10, 15 years, luxury goods have continued to do well. And so I wouldn't expect to see as much of an impact there, because it's simply when you're targeting an audience as affluent as those are, it doesn't tend to have as much of an impact.
Right. Just want to point out, Cook just now on the call citing about how strong the year was. 2 billion iOS devices shipped, best September quarter ever, 10th anniversary of the App Store. Overall, the quarter actually had the biggest quarterly growth spurt since 2015. Horace, I want to talk about the XR. There seems to be a lot of investor sentiment around this. Why all the excitement when it could be potentially cannibalizing its more expensive products?
Well, the XR is actually still a $750 minimum price. I mean, it's a significant rise over the $600 to $700 price points we've seen in the past for the leading products. So now we're seeing a sort of an uplift in the overall ASP. The product is also not necessarily cannibalizing. I think it's actually very interestingly positioned as a middle product in terms of screen size, which is what most people respond to when they look at the initial impression. It is a very solid product, and that's what surprises me a little bit. Now, I'm saying there's a little disappointment, but let's not forget we're talking about projecting here about 77 to 78 million units sold at an average of $800. So this is going to be still a great quarter. It's just not the sort of growth that we just saw, 20% plus in the top line. We're seeing almost a flat top line going forward here. Again, I'm actually penciling in a little bit of growth on the iPad, a little bit of growth on the Mac as well, single digits, low single digits. But it's not really, the big growth are services and other, which are in the 30 to 20% range, which are doing rather well and will continue to do well. But those are based off of an install base, which is over 1 billion devices, actually 1.3 billion devices out there, and that is where the services growth is coming from. It's just that I think there's a question whether XR was going to be a home run or not.
Julie, what's your take on that? Is the XR excitement justified? Will people upgrade for this cheaper-ish phone?
Yeah, and I think you see still a lot of consumers in the market that still may have a 6 or a 7 or an 8 that have been waiting to upgrade to something that's more affordable to them. And I think that, that's some of the target market we see them chasing.
And I just want to point out, Tim Cook talking about the new iPhones being the most advanced ever. They have 7-nanometer chips and are ahead of the competition in technology. And he's quoting reviews on just how good some folks think they are. Horace, you were talking about services earlier. They actually came in under expectations. What's your take on that? Is services not growing as much as expected?
Well, it's doing pretty well, actually. My expectations were in line with what we saw, and we saw about 10 billion quarter. They're certainly ahead of schedule in terms of hitting their long-term targets, sort of $50 billion a year run rate, and that's going to be reached probably next year and ahead of schedule. And that's not a bad story at all. There were some one-off charge or revenues that were not present this year, but overall, I don't think there's anything I can see negative about services right now. I think forecast now I'm looking at about 18% growth, a little bit less than we saw in the past.
All right, Horace Dagio, a Simco analyst, thanks for joining, and Julie Aska-Forster, you'll be sticking with us throughout the hour as we cover Apple earnings. Coming up, Google has come under fire for multiple executive misconduct claims, and now employees are protesting their list of demands. Up next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Google employees around the world left their offices Thursday morning in global protest against the company's handling of sexual misconduct. The walkouts follow a scathing report by the New York Times last week detailing the company's cover-up of multiple sexual misconduct claims against executives. The report claimed that the internet giant gave Android creator Andrew Rubin a $90 million exit package, despite verifying a credible harassment claim against him. Richard Duvall, a director of Alphabet's X Research Lab, also resigned Tuesday after being named in the article. Over 47 offices worldwide participated in the walkout, demanding several key changes, including future transparency and potentially an end to forced arbitration. Google CEO Sundar Pichai just responded at the New York Times DealBook event.
Obviously, it's been a difficult time. There's anger and frustration within the company. We all feel it. I feel it too. It's at Google we set a very, very high bar, and we clearly didn't live up to our expectations, and which is why we felt it was important to express our support for the employees today.
Here to discuss is Bloomberg's Josh Idelson and Pipeline Equity CEO Katika Roy. Katika, I want to start out with you. Sundar actually seems to be very supportive of the walkout, and in his statement, he's expressing sincere remorse. I mean, how would you judge the overall response of Google as a corporation to this?
So I think it's great that he's supportive of the walkout today, and then what will be important is the accountability and transparency going forward. So the response to the 5 requests that the Google walkout organizers actually requested as part of their demonstration today.
And Josh, one of the top demands that the protesters are asking for is an end to forced arbitration. Critics say this allows companies to basically hide the wrongdoing and silence the sexual harassment. Now, the tech giants have been called to end this before. Do you think anything could change this time?
Well, certainly we're seeing a wave of attention on forced arbitration. This is an issue that the National Labor Relations Board tried to address and got beaten down by the Supreme Court. The issue, according to critics, is that when people as a condition of employment are forced to give up the chance to bring their claims in open court, it hurts their ability to get a fair hearing, and it also hurts their ability to bring public scrutiny on these issues. It's something that we've seen the attorney generals of all states speak up about together, something that rarely happens, something that the media has paid attention to. And so, yes, the companies now, though they have the discretion to include these agreements, are facing more public pushback when they choose to, particularly as it relates to harassment and discrimination issues.
And it's really amazing to see the images and video come out of these crowds all around the world, and they do have a very distinct outline of what they're asking for. What do you make of their actual demands and the realisticness of the companies actually agreeing to this?
Well, they range. Realistic.
Oh, Katika, sorry, Josh, I'll get to you right after this.
And so it is realistic. The choice, the decision is not whether or not they will, is whether or not you can implement this. It's whether or not you choose to. So as Josh stated earlier this year, it was the first time in 10 years that all 50 states' attorneys general actually came together and asked Congress to change, to remove sexual harassment from binding arbitration agreements. We know that does ban people from basically having a voice. We know that pay, equity, and opportunity is actually possible. That's what Pipeline does. So we know that the demands, they can actually meet those demands.
And Josh, tech companies like to promote themselves as ethical, socially progressive. If Google does make these slew of changes, do you think other companies will follow suit?
I think we've seen already when one company moves, there's pressure on others too. We saw this dynamic, for example, with Facebook and Google on the question of protecting employees from retaliation in May 1st protests. And these companies are dealing with a wave of vocal and activist employees. While they have virtually all non-union engineers, we've seen increasingly workers banding together in the kind of activism that New Deal labor laws in the U.S. are supposed to protect, taking collective action together to address workplace issues. And social media has provided an additional outlet for people to get attention from other employees and from the broader public to what they're doing and how the companies respond.
Right, we did see Google decide not to renew a contract with the Pentagon based on the employee protests. And I want to, Katika, get to what your company does, which is uses AI to improve equity in the workplace. Have you spoken with Google about using your technology? And if not, what should they be doing?
Yeah, not yet. We haven't spoken to them. But what they should be doing is, what Pipeline does is provide a clear path and a shared understanding of how to actually get to equity. And if you think about it, every time time you make a pay decision and a hiring decision, a promotion decision, you actually have the opportunity to either move toward equity or not. And in the second request that the Google organizers demanded of the company was not only pay equity, it was actually opportunity equity. Because we know that pay is actually the symptom. The disease is truly opportunity, and how we ensure that every time you're making a promotion decision or a performance decision, you're actually making sure that it's equitable.
Well, Bloomberg's Josh Idelson and Pipeline CEO Kautika Roy, thank you for joining.
Thank you.
Now, sticking with the workplace in tech, Amazon officially raised the minimum wage for U.S. employees to $15 an hour on Thursday after announcing the increase last month. And while the company is touting the pay raise across all operations and employees in hourly positions, it turns out not everyone is eligible. According to Bloomberg, the minimum wage does not apply to Amazon Flex workers who deliver packages using their own cars because they are contractors. And though the company advertises an hourly rate of $18 to $25 for these drivers, interviews suggest actual earnings could be closer to $5 to $11. Here to discuss is Bloomberg's Technology's Olivia Zaleski. Now, Olivia, Amazon had agreed to raise the minimum wage across the board. How are they justifying the discrepancy with the flex workers?
Well, first, let me just describe to you what the flex workforce does and who these people are. So it's an independent contractor program within Amazon, and it works a lot like Uber or Postmates or DoorDash, in which people use their own cars to drive, and they're promised about $18 to $25 an hour. But what we found in our research is that, and we also used a report from research firm Bernstein, is that people are actually taking home closer to $5 or $11 depending on how they factor in their expenses. This is $5 an hour as they're driving in their own cars and paying their own tolls and paying for parking instead of Amazon paying those expenses.
Right, 18 to 25 and $5 to $11 an hour is a huge difference. How did Amazon respond to this?
You know, they were pretty unhappy with our reporting, but in all seriousness, I think they felt that the report that we used was unfair. The report that we used said that drivers actually ended up going about an hour and a half longer than what Amazon promised them in these blocks. So most blocks are about 4 hours. This report from Bernstein said that drivers were actually working about 5.5 hours because they were delivering or they were returning undeliverable packages to Amazon warehouses and not getting paid for that work. So they did dispute the report, and we made that clear in our article. But what we found in talking to a lot of drivers is that the report is backed up from the fact that most drivers, after they did their expenses, found they were making closer to $5.50 or $6 an hour.
Now, it seems like Amazon's move to raise the minimum wage to $15 was in part caving to political pressure, but also dealing with a tighter labor market. Clearly, they don't want to hurt their reputation. I mean, what do you think is the likelihood that they'll actually raise the wages for flex workers as well?
You know, they could end up raising them because it is competitive to get good workers, and the gig economy has become more competitive. So I could see them doing that, or, you know, chipping in on some of the tolls or expenses that come up when you're delivering packages, especially across state lines or to areas that don't have parking. So I think they may consider or reconsider their model. The Bernstein report that we used said that this is not a sustainable model for Amazon because people will eventually catch on and realize, these drivers will eventually catch on and realize that they're only making $5 an hour.
Right, your reporting really put in great detail all the burdens that these flex workers have to take on. As a result of this, do you think fewer workers will join the Amazon Flex platform?
You know, it's unclear. I mean, we did speak with some psychologists and a behavioral economist, and what I found so fascinating in doing this reporting is that people don't think about expenses when they take on a gig economy job. And it's actually, I think, hardwired in our brains that we think about the reward, what's going into our bank account. And our brains don't want to assess the actual expenses that are going to that we have to account for come tax time. So, you know, it's possible that they could continue to sort of survive on this model, hoping that people don't realize how much they actually have to spend to make these deliveries.
Great reporting as always. Bloomberg Technology's Olivia Zaleski, thank you for joining. And the Apple analyst call is still underway. CFO Maestri just began working us through the numbers. CEO Tim Cook just wrapped up, and he highlighted the strong growth of Apple Pay and transactions, and the Apple Watch as well. And he says he couldn't be more bullish about Apple's future. He also just spoke about a new store coming to Thailand. Now, about half of Apple stores are now outside the U.S. Here's Cook speaking about the whole quarter overall.
This year, we shipped our 2 billionth iOS device, celebrated the 10th anniversary of the App Store, and achieved the strongest revenue and earnings in Apple's history. In fiscal year 18, our revenue grew by $36.4 billion. That's the equivalent of a Fortune 100 company in a single year. And we're capping all that off with our best September quarter ever.
Apple's earnings call is still underway. CFO Luca Maestri says Apple now has more than 330 million paid subscriptions as part of its services business. Shares in after-hours trade are down. And some headlines coming in from Palantir chairman and PayPal co-founder Peter Thiel. He's speaking at the New York Times Dealbook Conference in New York. Thiel saying he would still support President Trump if given the chance again, and that the president's tax reform was, quote, a major achievement. The billionaire venture investor and Facebook board member spoke in 2016 at the Republican National Convention in support of Trump and served as a member of Trump's transition team, helping fill open positions in the administration. A group of Tesla shareholders wants the company's board to go beyond an overhaul ordered by the SEC. The recent settlement requires Tesla to replace Elon Musk with a new chairman for at least 3 years and add 2 independent directors. But these investors say the car maker should permanently separate the chairman and CEO positions and set timelines for some current board members to leave. And Amazon will stop emailing popular Washington Post stories to its customers in a possible attempt to separate the e-commerce giant from the newspaper's hard-hitting coverage of President Donald Trump. Since entering the White House, the president has sought to blur the lines between Amazon and the Post, which Amazon CEO Jeff Bezos has owned since 2013. Amazon says the daily email will be discontinued from November 5th. Still ahead, Europe wants in on the crowded cloud space, how SAP is taking on U.S. competitors like Salesforce and Oracle. Up next, this is Bloomberg. This is Bloomberg Technology. I'm Selena Wang in San Francisco, and for Emily Chang. Now back to our top story. Apple shares are in the decline in after hours. The investor call is doing nothing to soothe investor sentiment. The stock is now down almost 5% in post-market trading. Investors are concerned about Apple giving an underwhelming forecast for the key holiday period, suggesting weaker than expected demand for the company's pricier new iPhones. CFO Luca Maestri is currently speaking on the call, saying Apple will stop providing unit numbers for the iPhone, iPad, and Mac. Investors will not like this. Let's bring in our panel with Bloomberg Executive Editor of Technology, Tom Giles, and back with us, Julie Ask of Forrester. Tom, so does this really come as a surprise? We've known for quite some time that the average selling price would be more valuable to investors than the actual units sold.
Well, we know that that investors pay very close attention to the average selling price. They want to know if, when consumers are buying the device, are they buying the higher end? Now, ASPs came in at much higher than analysts were expecting. That's a good sign. Unit sales still, I mean, you can't completely dismiss unit sales. And unit sales for the past quarter were light. The overall revenue number for the coming quarter, the forecast, also missed expectations. And so that has really been weighing on the stock in after-hours trading.
Now, I want to touch on the other products category, which includes the Apple Watch and AirPods. It seemed to blow it out of the water with $4.2 billion in revenue. Do you think moving into the future this could be a more valuable component of the overall revenue mix?
So I think there's two things in play here. So one, with iPhone being such a dominant element of their revenue, nothing is going to replace the smartphone in the near term. There's no other IT device that's coming through. But the better they do with devices like the HomePod and the watch and so forth, then the better their services business will do because it becomes stickier. If I can play Apple Music on the 4, 5, 6, 10 Apple devices I own, it's a much more compelling bundle or value to the consumer than if I just own one device.
Now, I want to point out, CFO saying unit sales do not represent clear indication of performance of their company and are less relevant, also saying there's some macro uncertainty in some emerging markets factoring into the forecasts. Is he talking about China?
Didn't specify. We know Tim Cook talked to Reuters. There was discussion about emerging market weakness. Also talked about foreign exchange, talked about timing of the device, and concerns about whether or not they will be able to actually meet demand. So there's always that perennial question about production. Now, the backdrop of all of this is a brewing trade war between the U.S. and China. Apple have talked about some of their devices, some of their smaller products, less important products being affected. And there is just this general question mark over the economy about whether or not rising interest rates, trade war with China are going to dampen consumer sentiment heading into the holiday quarter. Remember, Amazon also had a forecast for the holiday quarter that came in lighter than expected. So there's a big question mark about whether global macroeconomic issues are weighing on consumer sentiment.
Right, and on that note, the FANG stocks, minus Apple, have been punished a lot more than Apple. They've been pretty resilient, which is interesting considering they have such vulnerability to what's going on in China. I mean, how are investors factoring in this China headwind? I mean, how long can they stay out of this trade tussle?
Yeah, I mean, that's a great question. It's one of many factors that are affecting the overall technology industry. As we've talked about on this show many times, October was a very difficult month for the industry overall. And some of the tech stocks have been falling even before October got underway. So it's a really difficult week. Lots of questions about this big data center build out, right? Companies have been investing in data centers, snapping up servers, snapping up the chips needed to buy them. And so that's something that's weighing on one part of the technology industry. But this consumer side of things, Apple is a huge bellwether, given its role as, in selling iPhones and other devices that consumers are after.
Right.
They're really emphasizing sales and of services, and they're emphasizing their selling prices.
And now Cook answered the question about deceleration in emerging markets, saying Turkey, India, Brazil, Russia, and he also said Apple's business in India was flat. How are they doing in emerging markets when you look at Apple versus competitors?
So I think, overall they do well, but, Apple's not in this to be the largest volume player. They're in this to be the most profitable player. And I think those markets are always a little bit challenging. Some of those economies, like, India and, and so forth, are large enough that the middle class and the upper class compare with the market in the U.S., but they're still, it's going to be a little bit softer. Those are, they're big markets.
All right, Bloomberg Technology's Tom Giles, thanks for joining. Julie Aska-Forster, you'll be sticking with us throughout the hour. Apple now down about 7%, by the way. And U.S. tech giants like Amazon and Microsoft are jostling for market share in the cloud. Now, Europe's largest tech company is looking for a piece of the action. SAP is known for its enterprise software for managing business and customer relations, and now it's pivoting its strategy towards its cloud suite. The tech giant saw new cloud bookings rise 37% in the third quarter and says it now generates more revenue from that business than from on-premise products. Now it hopes to take on Salesforce and Oracle, raising its cloud subscription revenue forecast for the current quarter to $6 billion. I sat down with CEO Bill McDermott to discuss.
You have a major move to the cloud, so if legacy companies haven't fully vested themselves in the cloud, where they've converted their revenue streams more to cloud than on-premise, I think you'll see them make bold moves to get cloud ready. So no choice. That's where the customer wants us.
So now Oracle recently launched this autonomous database that doesn't need human administrators to function. I mean, do you see a lot of competition from this? Are you developing something similar?
Yeah, we obviously have taken over the enterprise database market with HANA. So HANA has many of the characteristics that you mentioned, but moreover, HANA can take data from any source. So everything that is either structured or unstructured and data from any source in the enterprise, HANA's running the biggest enterprises in the world now with more than 25,000 customers at mass scale. So we like our HANA database very much.
Now, sticking with competition, I want to talk about Salesforce. What is the plan to catch up with them in the customer relationship management cloud market?
We see a fourth generation of CRM where we go beyond the current market participants. Basically, they focus on sales, marketing campaigns, things that essentially take money out of the customer's pocket. What we want to do is focus on an omni-channel e-commerce world where we connect the demand chain, because that customer's social, they're mobile, they're on the run. They shop in every channel, direct to consumer, wholesale, retail. And we want to connect that demand chain to the supply chain so you have a complete end-to-end business. Why is this so important? Because we're not just talking about CRM. We're talking about customer experience, the way CEOs think about their brand, their products, their human capital, their customers. All of the people inside a company have to be completely committed to the customers outside the company. This is what we call fourth generation CRM. It's all about the customer experience.
Now, you've met with President Trump before. Wall Street was very quick to cite the tax reforms as a way of future profit growth, but now the focus has really changed to his decision around tariffs. I mean, what's your assessment of his performance, and what are you hearing from clients and partners around this?
Well, the most important thing is we get paid to run businesses and work in an environment where we let government do what government does. And all government leaders have to do what's best for their country and best for their constituents. And these tariffs are obviously a serious situation. You have the two largest economies in the world, 30 trillion in combined economic firepower, right now a little bit at odds with each other. So it's good, and you saw today's tweet when it was like stated that at the G20, President Xi and President Trump will sit down and talk. That's very encouraging to the markets. Markets like certainty. So certainly we'd like to see China and the U.S. cooperate. It's good for supply chains, it's good for business.
And China's a very important market to SAP. You've been there for a long time. I mean,
yes.
How are the current tensions impacting business? It's a German company, so is it good for business in a way?
Well, in a certain sense, you could say that. German engineering is highly regarded in China, as it is in the United States and around the world, but we do particularly well in China. And China is our fastest growing market, and we think that China is easily regarded as SAP's second home in terms of the market receptivity, the ecosystem growth in China, and our long-term prospects. We think China will end up being the biggest market in the world soon.
What is your approach to servicing customers there, given the data privacy concerns?
Well, we have, as you know, or probably do know, the most sophisticated data privacy technology in the world. We acquired a company called Gigia, where we have billions and billions of customer records. So we protect your privacy. We don't let customers actually engage you unless you agree that you want to opt in on various offerings from our customers and how they serve their customers. So we follow the same reference architecture, high security standards and cloud standards in China that we do in Europe, as well as the United States and every other theater in the world. We are very confident in China and the way enterprises can serve their customers in China with high security standards. We recently announced a very important partnership with Alibaba, and that is a cloud partnership that will not only impact our growth in China, but also the ASEAN region, which is one of the fastest growing regions in the world.
Now, lastly, succession is a big issue at SAP. Who have you lined up as future leaders, and are they diverse?
Yeah, that's a great question. We actually have just appointed within the last 12 months 2 women to our executive board, not just because they're women, but because they're great leaders. And that would be Adair Fox-Martin and Jennifer Morgan. If you look at our company, we have 1/3 of our workforce that is female. We also have 1/3 of our leaders that is female. So we're very diverse. We're highly inclusive. One of the things we really enjoy is what we've done with autism at work. And now we've dedicated 1% of our hiring to autistic folks, at least on the spectrum somewhere, to basically help our workforce be highly productive and diverse. So that extends also to the solutions that we have. So if you look at SuccessFactors, the #1 human capital management solution in the world, we have a business without bias mentality. Computers don't have bias. So in the way we build the algorithms in the software, they eliminate bias from the hiring process. So the computer doesn't have a bias. It looks for the best candidates, and it fills an algorithm or a model that the company is trying to get at. So if you want 40% of your workforce, for example, to be diverse and inclusive, the model is built to do that for you. So you don't leave it up to humans. You let the software do the work, and then the human judgment comes in at the final phase of hiring. It's changing companies everywhere.
That was SAP CEO Bill McDermott. And coming up, Spotify out with a lackluster third quarter due to unimpressive user growth. What this means for the future numbers of subscribers, up next. And Apple's earnings call is still underway. CEO Tim Cook is speaking about Apple global growth. Cook says Apple's business in India was flat, and he would obviously say that he would like to see huge growth there. Yet Cook did say that business in China was very strong, though game approvals in China is far below historic pace. And another big headline from the call, Apple will no longer report unit sales for iPhone, iPad, and Mac. Here's CFO Luca Maestri explaining.
Starting with the December quarter, we will no longer be providing unit sales data for iPhone, iPad, and Mac. As we have stated many times, our objective is to make great products and services that enrich people's lives, and to provide an unparalleled customer experience so that our users are highly satisfied, loyal, and engaged.
More headlines from the Apple call still underway. When asked about Apple and healthcare and growth in subscriptions, CEO Tim Cook said Apple has a huge opportunity. Cook says Apple has an intense interest in the space and has added non-monetized products. Sticking with earnings, shares of Spotify took a hit after the company's lackluster forecast. Third quarter subscriber growth was roughly as expected, but the revenue outlook is troubling to investors who are betting on paid streaming services. Spotify now expects fewer monthly active users and premium subscribers in the fourth quarter. For more, let's bring in Bloomberg's Cameron Leach to discuss the future of music streaming service, along with Bloomberg Intelligence, Sean Handrahan. Sean, I want to start out with you. Third quarter subscriber growth was roughly as expected, but revenue outlook was not so great because they were betting on years of growth in paid streaming. Are investors sort of lost on that hope right now?
Yeah, so it's actually a very competitive space. Investors are looking at, where are the subscriber numbers going to come from? They had raised their guidance for the fourth quarter in terms of additions of subscribers, and they actually cut it back again in the third quarter. So investors are kind of like, what's going on here? There's a change in the outlook in terms of competition for Spotify.
And Cameron, Spotify had some recent tensions with the record labels. They are also facing competition from larger giants. I mean, how much room for error is there for Spotify?
The margin for error is very small. I think what I've been told from a close source of mine is that at a record label, their working relationship with Spotify is doing quite well right now, but what does that mean for the entire record industry? We don't know quite yet. We'll have to see going forward. But I think what's really important right now is looking at the monthly active users. It's good to be able to bring in total subscribers. It's at a decent amount, 87 million for the third quarter. But if we look at the monthly active users, it's actually lower than expected. And if you can't get your subscribers engaged, that's a problem that investors have to look at moving forward.
There was also a continued decline in the average revenue per users. What was driving that?
Yeah, so they have shifted to doing family plans and student plans from the original $10 a month, and those come in at lower price points per user. The investor concern there, they knew this was coming, but Spotify is also planning to raise its expenses next year and increase its R&D spending. So with subscriber outlook in question, revenue per user coming down and growing expenses, sort of questioning, can this company grow profits longer term, those sort of things, if its market share isn't growing as fast as expected.
Cameron, what about Spotify's push into other types of audio like podcasts? Are investors seeing a payoff from this yet?
This is something that management has not looked forward to yet. That is a sector that they are considering. They've launched new podcasts like Joe Budden's podcast, but this is something that could be a growth driver for them.
And Spotify also had a recent partnership with Google. They're offering this free home mini product. How much is this supposed to drive subscriber growth by?
Right, in the call, they give very limited information around what they expect from that. Basically, if you're a family plan subscriber and you sign up, you get a free Google Home Mini. That may bring people in. It's nice that Google's sort of neutral in the ecosystem. They can tap the Android marketplace with this, and that'll show up later over the next 12 months.
Sean, how would you rate Spotify's performance right now against its competitors?
It still holds the market share lead. You know, it's still close to double the size of Apple in terms of paid subscribers. It's doing well. I think they need to keep proving in 2019 that they can hold fast subscriber growth, and that's going to be the key for investors. If they start to lose market share, it's going to be a big question mark for the company.
All right, Bloomberg's Cameron Leach and Sean Hundrahan of Bloomberg Intelligence, thank you both for joining us. Coming up, we get back to Apple earnings. The market's not liking comments coming from management on the call right now. Apple shares still near their post-trading lows, down over 7%. We've been following Apple's earnings call as it happens throughout the program. The stock has slumped more than 7% in aftermarket trade, possibly putting its $1 trillion valuation under threat. CEO Tim Cook has been asked about the company's aims in healthcare, the expansive product line, and trade tensions. He's asked also what to say about the game approvals in China. Now, still with us is Julie Ask.
Set up in China, and things are not moving the way they were moving previously. We did see a few games approved recently, but it's very far below the historic pace. And as you've probably seen, some of the larger companies there that are public have talked about this as they've announced their earnings as well. We don't know exactly when this will, the approvals will sort of return to a normal pace. So I would not want to predict that. I do not view, just for avoidance of doubt here, I don't view that issue has anything to do with the trade-related discussions between the countries. I think that is strictly a domestic issue in China.
Still with us is Julie Ask Forrester. Julie, clearly markets are underwhelmed with the results so far. They're slowing growth. Do we need to sort of reconcile with this new reality of slower growth, and why is that?
Well, I think there's this part where, because devices and hardware have been Apple's history for so long, there's a set of expectations around those kinds of products. But I think growth in the future is going to be slower in some ways. When you look at the services market, we're not getting $700, $800, $1,000 at a time. Every 99-cent game that's sold returns about 30 cents to Apple. And so I think it's just, and it's also, the other part of it is when you look at the upgrade cycles, those are slowing. These devices are amazing, and you have to be a user of games or some of the more, what I'd call the more demanding applications on the phone to really need that upgrade. I don't need a 10 to do email. I do need a 10 to play the latest video games, and so it's related.
Right, but there's a lot of excitement around services because it's creating a revenue stream that's not dipping seasonally, and if we look over the span of several years, it's been steadily climbing up. Is there something Apple should be doing to create faster growth there? I mean, the services revenue is composed of many different products.
Yeah, so I think the hard thing is it's hard to accelerate that growth. So on one hand, when they do get a customer, especially for a subscription service, that's steady and that goes long term. But this is also, services are a lot more dependent upon ecosystem partners. So whether it's Apple Pay or its music or its media or what's in their media library. Apple just can't flip a switch and make that all happen. It's kind of like grinding it out day by day to sign up more partners, negotiate deals, get more services. The more devices that a consumer owns within the ecosystem, the more valuable those services are. But it's something that grows much more slowly, I believe, and much more organically. It's not about a big bang, wow, I have to have that new product once a year. It's just, it's slower.
And given the importance of the services business and how difficult it is, how concerning is the fact that the App Store sales in China have slowed and there are these regulatory issues around the gaming licenses?
Yeah, so I think that's a component of that they're going to have to work through, and that's certainly, an important element of that market. And I think, one of the benefits they'll get is if they can accelerate that, those are certainly the kinds of applications that drive demand for new hardware.
All right, Julie Aska-Forrester, thanks for joining us this hour. And that does it for this edition of Bloomberg Technology. Tune in tomorrow on the show, full coverage of Alibaba earnings and our interview with co-founder Joe Tsai. GoPro CEO Nick Woodman will also be joining us around earnings, 5 p.m. New York, 2 p.m. San Francisco. This is Bloomberg.